Hi, welcome again to my YouTube channel. Once again, my name is Bernard Ogabo, but I go by the sobriquet of Professor Emeritus. Today, we are going to be looking at Leases IFRS 16. When I briefly explain the concept of leases, then we shall do an illustration to, a calculation to show how these explanations are presented. When we are asked to account for leases under IFRS 16, the major type of lease we account for under IFRS 16 is finance lease, which is a departure from what used to be obtainable under IAS 17, where we account for leases in the book of the lessee using operating lease and the finance lease based on the scenario that we have. But for IFRS 16, the key type of lease that we account for is called a finance lease. So at the inception of a lease, there are two things that you need to look for. Number one is the right of use of the lease. That's right of use. And two, the fair value or the present value of the lease. These are the two things you should, if you can find these two things, you'll be able to answer any question in finance lease. So when we say right of use of a lease, what are we looking at? At what cost do I recognize the asset for which I am leasing? And number one, the direct cost incurred attributable to the lease. Like before you enter this lease, if you pay legal fee, consultation, any legal or professional fee that you pay just because you want to enter into this lease is a direct cost. Present value of future lease payment. I highlighted it because it's one of the things you need to look for to be able to answer questions in leases. Number three, present value of any future dismantling cost. If it was an asset that you install, like a drilling a set of equipment, and you need to remove them at the end of a lease term and restore the site to where it used to be, you add it to the right of use of the equipment. Any advance payment to the lessor or at the commencement of the lease period that you did not receive any benefit for. When we say benefit, if it is not a contribution towards paying your regular payment for the lease, it is added as right of use. But when we talk about the present value of the future lease payment, we are not talking about, when you enter a lease, there are two things you can do. It's either you deposit some money, and then pay the remaining part of the cost of the asset over annual or monthly or quarterly installments, or you do not deposit any money today, but you take the asset on a promissory note that you're going to be depositing some money every time. So that is the fixed payments that you make. Then amount expected to be payable under residual value guarantee. So let's assume that you tell the owner of the asset, because in a lease agreement, you enter an agreement to take an asset from the owner of an asset called a lessor, and you will be the lessee, and you pay you make payments to the lessor as a compensation for the asset that you are using. So if you are using the asset for 5 years, for instance, and you tell the lessor that the asset at the end of 5 years, I believe that your asset will be worth 100,000. If there is any delay, or if the asset falls below that value, you are supposed to make some payment to the person. That's what we call residual value guarantee. Option to purchase the assets that are reasonably certain to be exercised, and termination penalties. So let's say if you enter the lease agreement and then you decided to opt out of the lease, if there are penalties to be paid, all those ones come under the present value of future lease payment. But know that everything you have here, it is part of what we call right of use. That is why I highlighted this. So if you have 5 items here and add all of them together, they will become like the second thing you need to add under what we call the right of use of an asset. So capital lease, what are the features? When you say capital or finance lease, the lease covers almost the entire useful life of the asset that you are leasing. The risk and reward associated with the assets are transferred to the lessee. The lessor does not have the right to substitute the asset while it is in use. This one comes under multiple choice for ACCA student. The lessee is the only person that has the right to direct how the asset is to be used, and there may be a right to buy the asset at the end of the lease period. Another thing we need to look at under IFRS 16 leases is that how do we calculate depreciation? Mind you, we don't depreciate the future value or the present value of the future lease payment. We only depreciate the right of use of the asset. So there are two ways, options of depreciation. Depreciation, you can depreciate the asset based on the shorter of the lease period or the useful life of the asset. If the asset had a useful life of 20 years and the lease period is 10 years, the depreciation will be based on 10 years. But you can only depreciate the asset based on the useful life if the lessee is going to buy the asset. If the lessee, not the lessor, has been given the option to buy the asset at the useful life of the asset. So the shorter of the lease period or the useful life of the asset is what we use to depreciate the asset. So with all these theoretical backgrounds in mind, let's now go ahead and look at an illustration. It's a lessee enters into a 20 years lease of one floor of a building with an option to extend for a further 5 years. Lease payments are 80,000 per year during the initial term and 100,000 per year during the optional period. All payable rather at the end of each year. To obtain the lease, the lessee incurred initial direct cost of 25,000. At the commencement date, the lessee concluded that it is not reasonably certain to exercise the option to extend the lease. Therefore, determined that the lease term is 20 years. So, if the lessee was ready to exercise option of extending the lease by 5 years as provided here, the lease term would have been 25 years and not 20 years. So the interest rate implicit in the lease is 6% per annum. So you could take a snapshot of this question as we are going to be using it to answer, the requirements that are followed. Number one, what is the lease liability at the inception of the lease? Remember that lease liability constitutes any of these items that we've mentioned here: fixed payments, amount payable under residual value guarantee, and so on and so forth. But there's something else I want to let you know. Now, when we talk about lease liability is slightly different from the fair value of a lease at the inception of a lease. Lease liability represents the part of the cost of the lease that you are yet to pay, that will be paid in the time to come. When you add it with any deposit that you've made at the inception of the lease, the two together give you what we call the fair value of the lease. However, in most lease questions, the lease liability may also be the fair value of the lease. I hope you get that. So, and number two, we've been asked, what is the right of use of the lease asset? We are going to try to determine what the right of use of the asset is going to be. Then, how should the lease be accounted for over the useful life? Over the next 5 years, because the useful life is 20 years, so we cannot do the entire 20 years. So what is a lease liability at the inception of the lease? We have been told that it is the present value of the fixed payment. So if you see lease liability at the inception of the lease, if you use your discount factor table, you find that because we'll be paying 80,000 per year for 20 years, you go to cumulative discount factor table, you look at 6% in 20 years. The cumulative discount factor for that period is 11.64699. So if you multiply 11.6499 by 80,000, which will be paid every year for 20 years, it gives you $917,600 as the fair value or the present value of the lease liability. Remember that, let's assume that if this lessee paid 100,000 as a deposit, then he's going to pay 80,000 per year. If you add that 100,000 to this amount, that becomes the fair value. But in the absence of any initial deposit, the fair value and the present value of the liability are the same amount. Secondly, we've been asked, what is the carrying amount of the right of use of the asset? Right of use of the asset is the present value of the lease plus any direct costs. So we've calculated the present value of the lease payment to be 917,600 and direct cost of 25,000. If you look at that question, I highlighted 80,000 in red and 25,000 in red. So when you add the present value of the lease to any direct costs that have been, paid, it now gives me the right of use of the asset. Then let's look at the depreciation charge. Before we ever look at number 3, we want to calculate the depreciation charge. So depreciation charge is the right of use either over the useful economic life or over the lease term. But here, we are not even going to look at the useful economic life because the lease term is 20 years, and we were told that the person had the opportunity to have extended for 5 more years, but he did not. So over the lease term, the shorter of the lease term and the useful economic life of the asset is depreciation. So depreciation is right of use divided by lease term, and depreciation per year is 47,130. 47,130 is annual depreciation. So how do we account for the lease over the next 5 years? Now, I'm going to ask you some other questions below to give a broader overview to the kinds of questions you'll be asked in your exams. When you are to account for the lease liability over the life of the lease of the life of a lease asset, one of the things that you can do is to ensure that you bring in the present value of the lease liability, not the fair value, not the right of use. So the present value which you calculated was 917,600 at the beginning. Then you add interest, because interest implicit is 6%. You add interest at 6% of 917,600 is 55,056. Then you subtract the annual payment, and the value of the lease at the close of the period for year 1 is, the liability rather, is 892,656. The 892,656 in year 1, at the end of year 1, becomes the value, the opening value at the beginning of year 2. I take 6% interest and add to it. Then I subtract the annual payment. I have 866,215. The closing value at the end of year 2 becomes the opening value at the beginning of year 3, then I take 6% and add, then I subtract the annual payment of 80,000. It gives me closing value at the end of year 3, and I continue the same way until I reach year 5. One more thing I want to say, if you look at the question that you have, it says that the lease is payable at the end of the year. If deposits are made at the beginning of the lease period, what you do is that first you bring the balance forward, you subtract the annual payment before you add the interest. That's the difference between when payments are made at the end of the year and payments are made at the beginning of the year. Then let's ask a few other questions to help us, know the other aspects of question you could have in the list. What if they ask you, what is the finance cost or the amount to be taken to profit or loss? So the finance cost is this amount. This interest is what goes as finance cost to the statement of profit or loss. Either any of these places is the finance cost. Then what is the current liability amount for year 1 and year 3? I have done year 1, so you do year 3 on your own. So if I want to, at the end of year 1, this is the lease liability outstanding at the end of year 1, but it includes all the lease payment I'm supposed to make from year 1 to year 20. So that being the case, to get the current liability, it is this amount minus the balance at the end of year 2. The difference between these two gives me the current liability at the end of year 1. So that is what I have done here, but there's another option to do in another way of doing it. So, which is 892,656 minus 866,215, which is 26,441. Or I will say the lease payment in year 2 minus interest in year 2 gives me current liability for year 1. If they were asking you current liability for year 2, you either say 866,215 minus 838,188, or you say 80 minus 51,973, and that gives you the current liability for year 2. Then what other question do I need to, what other thing can I look forward to doing? Then they ask me, what is the carrying value of the right of use of the asset at the end of year 1? When we are calculating the carrying value of the right of use, is equal to right of use minus depreciation, gives me the carrying value. So in this case, right of use here, we've calculated it to be 942,600. I'm going to copy that, 942,600 minus annual depreciation. We calculated the depreciation to be 47,130. So 47,130. So what does it give to us? Because the depreciation is constant, even if they ask you for the annual depreciation at the end of year 5, the right of use of the asset at the end of year 5, all you need to do is to say right of use less depreciation multiplied by 5 years. So if I say 942,600 less 47,130, I have 895,470. So I say I have 895,470. So that is the right of use at the end of year one. I hope that brief explanation and the illustration provided enough insight for you. Thank you for watching the video. Like, share, and subscribe. In the next video, I'm going to be doing video on low value lease, low value lease, and low value lease. That's what I'm going to be doing in the next video. So see you in the next video.